Welcome to Broken Pie Chart Podcast, episode 126. Yeah, it's 126. I'm your host, Derek Moore, and this week we're going to be talking about a couple things. Before we get to the earnings discussion on the S&P, how earnings estimates have changed over time, certainly from when we saw them posted, February and March of 2020 and into the summer of 2020. They were really low. We've seen earnings estimates get ratcheted up and what that sort of means for PEs and future PEs. So we'll go over that. The other thing I wanted to go over is, somebody asked me a question about just the idea of this payment for order flow and investors not getting the best price. And I said, I probably won't do an episode on that. Honestly, it would put most people to sleep. But I'm reminded of something that happened on the show Fast Money. So I think there was someone on talking about how the spreads should be more narrow, if I can say that correctly. And by spreads, mean the bid and ask. So if it's bid 50 and it's ask 50.01, it means the ask is $50.01. And the bid is $50. And so if you're selling at the market, theory, depending upon the number of shares, you should be able to get the bid. If you're buying at the market, you should be able to get the ask. Of course, you can put in a limit order for any price that you want, and if it's fillable, it's fillable. But, these people were on, and they were kind of making a big deal about the payment for order flow and how spreads need to narrow more. And if they did, and so Guy Adami was on Fast Money, and one of the things he pointed out is, and he's always on Fast Money, he's one of the regular personalities on there. But I think he made a great point, and that is, do you know how much things are better now? Do you know how little the costs are? We have zero commissions. Do you know how narrow the spreads are now? They're essentially a penny wide in most cases for the majority. You do have smaller stocks or less volume, stocks that trade on exchanges that you have more of a wide bid or ask. But for most of the liquid stocks, the spreads are really tight right now. And he made the point of, 20 years ago, 30 years ago, the spreads, even on a stock like 3M or Intel, big stocks that traded a lot of volume. Well, stocks didn't trade in decimals. When decimalization happened, it sort of ushered in the ability to narrow spreads more. But stocks used to trade in fractions. In fact, I remember you had to always know the conversions between what a 16th was to decimals, what an eighth was, a quarter, 5/16ths, all that sort of stuff. So, they would trade in fractions. And not only did they trade in fractions, but they would also trade with a much wider bid-ask spread. In fact, I remember it wasn't that uncommon to have quarter-point spreads, half-point spreads, maybe even more. Can you imagine today a stock like Apple, which essentially should have, in most cases, right, they're going to have like penny-wide spreads. It's very liquid, very big stock. But back then, even the mid to late 90s, you would have these very wide bid and ask spreads. Of course, you could always put a limit order in, but remember what I told you. If you're buying at the ask or selling at the bid, depending upon the number of shares, you should be able to, at that time, get the trade-off at those prices. So when you think about that, let's just look at the bid-ask situation. You've got big stocks back then used to trade in quarter, half point wide, even more. Some stocks were even more. Difference between the bid and the ask. And today, big stocks pretty much a penny wide. The other obvious one is that commissions. So, commissions right now are essentially, well, not essentially, they're free. Schwab, Fidelity, TD Ameritrade, a number of the other ones that have popped up. But yeah, commissions are zero. They're zero, which means, back in even the late 90s, it would cost, if you're buying 100 shares, 200 shares, it might cost you $50, $75, $100. If you're trading, and back then it was sort of, there used to be a formula, the number of shares and the dollar value of the transaction. But it could get quite expensive. I mean, think about it. If you were a smaller investor and you said, hey, nowadays you put $100 into a stock, you just buy the stock. That's it. You buy the stock, it's in your account, and there's no commission. So if you want to sell it, it goes up a tiny bit and you want to sell it, you get to realize that profit. Well, back then, imagine buying a $50 stock and you pay $50 or $75 or $100 in commissions. That stock has to go up quite a bit before you can even break even. And not to mention, if you were going to sell the stock, you get hit coming out of the stock as well. So I agree with Guy Adami, and I think a lot of investors, and maybe it's just not having seen that period in the 90s, but I think a lot of investors sort of worry about the wrong thing. And, without getting into the payment for order flow and all that stuff, you just got to understand that if you are buying a stock or selling a stock, if you have a price in mind that you don't want to sell it for lower or buy it for higher, and if you use a limit order, you're already saying, hey, this is the most I'm willing to pay. And if you're trading market orders and it's a very fast market, maybe that's a different thing. But I think it's never been better for individual investors. And I'd also say, some of the stuff that I say you all, meaning, if you're in retail, but, most investors have access to technology and statistics and different stuff. I hear people telling me what the delta, the gamma, the theta of options are nowadays. They're small investors. And why? Because on the platform, it simply has all that available. Years ago, I can remember we had access on the trading group. We had access to a Bloomberg machine. And that's how I would look up, the option Greeks like the gammas and thetas and deltas. And if you wanted to get time and sales, look at, level 2 quotes. That was all on this Bloomberg machine. Those are quite expensive. So yeah, it's much better nowadays, I think. And I think investors, and that goes for retail and institutional as well, much more technology access, much cheaper to trade nowadays. And so I agree with Guy Adami. I think it's never been better. Oh, and one last thing on that whole bit. I expect someone to email me and say, but what about this? What about that? But I do think there's an unbelievable benefit to being an investor nowadays as opposed to in the past. And here's one of the other things that people forget. A lot of times we look at maybe historical returns of the S&P 500 and we assume dividends reinvested. So we look at the appreciation and then the dividends as a total return. People forget, right now for no commission, you can buy a share of the SPY that essentially holds the entire S&P 500 index, and you can have dividends reinvested for free. But think back. It wasn't until I think it was the late 70s, early 80s, where Vanguard first came out with an index fund that mirrored the S&P 500. Prior to that, if you wanted to create an index or mirror the index, think about it. You'd have to go out and buy those 500 stocks. You'd pay a commission for each and every one of them, and it would not be cheap. And if you wanted to reinvest dividends, there was no automatic reinvestment of dividends back then. You would have to get the dividend and then take that dividend and then go ahead and purchase shares. And guess what? You couldn't buy fractional shares, certainly. So your cost, think about it this way. If, let's say you bought 500 different stocks and the commission on average was about $50, it would cost you $25,000, 50 times 500, $25,000 in commissions just to get into all those stocks. And then imagine you rebalanced or had to add. I'm just saying it's a lot better now than it ever was. Okay, let's talk about earnings. So normally when we think about earnings per share, you probably refer to an individual company. And so company XYZ has 1 million shares outstanding. If they make, I don't know, $10 per share, that basically means their net income is on $1 million, $10 per share is 10 million, right? And so if the company, depending upon what the company is trading at, their price to earnings, let's say on the company is trading at $40. So 40 times 1 million shares outstanding is 40 million. We know they're earning $10 a share. So $10 on 1 million shares is 10 million in net income. So the market cap of 40 million, their net income of 10 million, they are trading at a price to earnings ratio or PE ratio of 4, meaning you're taking the 40 divided by the 10. So they're trading at 4 times that. That, by the way, would be considered pretty low in most cases, right? But I'm just giving you an example so you kind of get on the footing of what I'm talking about. But that's for individual stocks. And every individual stock typically has an analyst. I shouldn't say everyone. Maybe there's some that don't. But let's say, in the S&P 500, for example, most of those are going to have multiple analysts. Some stocks have more analysts covering them than others. But they give their forecast, they give their estimates of earnings, and typically they give the estimates the next, so what are we? We're in earnings season right now. And so, one of the things I'd urge you to do is keep an eye on things over the next couple of weeks, because every day before and after the market, you're going to see companies releasing their earnings. I think, what was it? Netflix was last week. I could be wrong. But that's sort of your time where you can get a look and see what the financials or the updated financials of a company are. And sometimes they make forward-looking statements, and the CEO goes on, a webcast and takes questions from analysts. But you also can have analyst estimates on the entire market. And so when we say the entire market, obviously it could be the Wilshire 5000, it could be the NYSE. But the one that most people watch is the S&P 500. So the S&P 500, you might look at the NASDAQ, but the S&P 500 is sort of the core one that you would be looking at. And so when you think about the S&P, it's trading what? What did the S&P finish on Friday? I think it finished, 4411. So 4411, that's what the index closed at. And that, by the way, I think that was a new all-time high. I'd urge you to go back and listen to Jay and I's podcast that we did, where we found that markets, surprisingly, a very high percentage of the time are within 3% of an all-time high. So, and by the way, listeners to this podcast know that our core idea of what we do with investing is the idea that you sort of buy the market and then you hedge. And then, none of this is meant that I think the market's overvalued or undervalued, but I want to show you things to look at and ways to sort of, keep an eye on things. Okay. So the market is, 4411, right? So how do you value the market as a whole? Like, how would you know what a PE ratio is? Well, one of the things you can do is you can figure out and aggregate all of the earnings for all the companies that are going to be in the S&P 500. And you can look and say, boil it down to a per share basis. And to give you an example, the estimates, and there's a range, but I just pulled estimates, probably around 195 to 200. And when I say 195 to 200, I'm saying $195 per share to $200 per share on the S&P, all right? So if you were trying to figure out what a PE ratio was or is on, let's say, the S&P 500 for all of fiscal 2021, and of course, we do have actual earnings for the first quarter. We don't have them for 2, 3, and 4 yet. You've got to have all the companies come out. But the way you would do that is take the 4411 divided by, let's just say it's going to be 195. And so we're trading at 22.6 times, or PE ratio, 22.6 times earnings on the S&P 500. Okay, so that's a way of looking at it. And I'll talk a little about where that puts us. Actually, let's do that now. Let's talk a little about what that sort of means with regards to, where earnings are. And I pulled up JP Morgan's Guide to the Markets. If you haven't looked at that yet, if you Google that, you've got to register with your email. I'm not sure if it's only for the institutional investors or if anybody can get this. But they've got a ton of information they put out. It's all free. But to give you an example, if we're at 22.6 PE, the 25-year average was 16.71 times, according to the data in JP Morgan's. So does that mean that we're really overvalued and you should sell now? I have no idea, right? Sure, you're above the 25-year average, but we've been above that average before. Do I think this is the and by the way, that's based on a consensus. So JP Morgan, all these firms have a different consensus. Their consensus for the next 12 months is $203. Okay. But yeah, I mean, we're obviously trading above the range. We'll see what happens there. The interesting thing though, when you go back to 2020, as I said, February and March of that year, earnings estimates came all the way down to $160 per share. And I think some firms had it even less for 2021. And think about that. So 160, and now we have estimates, around 200, let's say, 195, 200. In fact, JP Morgan has it 203 for the next 12 months. So that would include the last 3 quarters of this year and the first quarter of next year. But that's quite a bit. And that's a good example of how analyst estimates can change over time. So even though that firms might think, okay, they're going to get $200 a share around for 2021, if things change, those estimates could change. They could go higher or lower. And if you're watching earnings, one of the things you want to see is, are companies beating estimates by a lot? And if so, by how much? What's the percent? Or are they missing estimates by quite a bit? So you look at this and you say, okay, well, we have about $200 for 2021. For 2022, the estimates probably around $215 a share. And so a 44.11 market divided by, let's use 215. And that's trading about 20.5 times earnings. All right. And then you go to 2023. Yeah, I think that's the year, 2023. And there, not everybody has estimates that far out. But it looks like, a few firms, I think, was it JP Morgan? No. Yeah, actually, JP Morgan, I think they updated theirs. I saw on a Market Watch article that they actually have 245 for 2023, although I've seen other estimates, 230, 235. So let's use that. Let's use 240, and then if you do 44.11 divided by the 240, you're trading about 18.3 times forward 2023 earnings, right? So, look, this is earnings are one of. There's fundamentals, there's technicals, there's economic aspects. We're in the midst of it looks like still dealing with COVID, and that could have some headlines. But we've seen earnings estimates rise, but here's the thing: until you get the actual earnings, you really don't know if the estimates are correct. And here's the other thing. Are we certain that in 2023 that, we're going to have the earnings right around 240? Absolutely not. If things and conditions change, you're going to see those, those levels change again. So here's a couple inside things too. Not inside, but just some things to think about. So earnings per share, which we said was the net income for the company on a per share basis. And then we talked about the PE, the forward-looking PE, how many times earnings is a company trading. When you look at earnings, what causes earnings to increase or decrease? Well, I mean, some of the main components are you have the margins, meaning the profit margins or net profit margins, meaning, if you were selling something for $100 and it cost you $90 to make, you would say, for every $100 that you sell of that, you make $10. So your net profit margin is 10%. Well, what if your cost came down or you were able to charge more as a firm? Well, if your cost went down to 80, selling it for 100, that's a 20% net margin. So it looks like so far, if you look at the share of earnings per share growth in 2021, and this is as of, it looks like July 22nd. And it's worth noting is, again, we don't have all the second quarter earnings. We're very early into earnings season. But in 2021, earnings are up so far 59%. In 2020, they were down 22%. So when you get that downturn, obviously a lower, you have the numerator denominator thing, right? Same thing we've been talking about with regards to inflation. But just looking at the numbers, if you look at so far in 2021, margins are up 46.8%. Revenue is up 12.6% or 12.7%. And the other aspect of this, right? So revenue is important. So your margins, what's your revenue? So revenue is an input. And then share count. And when you think about growth of earnings per share, well, remember my initial example where we had, what did we say, 10 million in net income and 1 million shares. You were at 10 PE. What if the company did a share buyback? Now, companies can issue dividends as a way to pay out cash flows to investors, return of capital, right? They could also reinvest that into the business, but they could, instead of paying a dividend, they could buy back their own stock and reduce the float. It's sort of like an augmented dividend, or it's a different way of returning capital to shareholders. There's obviously debates on those. I encourage you to find the old episode I did, Are Share Buybacks Bad? Where I went through all of that. But reducing, in our initial example, if let's say the company bought back 100,000 shares, so now on that same 10 million in net income, what if the company only had, instead of 1 million shares, they had 900,000 shares? Well, what happens to the earnings per share? They go from 10 to 11.11, and then a bunch of numbers after that. So we'll just round to 11.11 per share. And so the share count, if you have buybacks, it's interesting though. It looks like the share count caused negative 0.6% attribution to EPS. So it was actually negative, and that could be companies issuing. They were net issuers of shares. So we'll see what happens with buybacks. So yeah, I mean, if you're looking at S&P and you're looking at the earnings per share estimates, so what exactly are you trying to figure out here? Like, what's important to you? The first thing I would say is, we talked earlier in the broadcast about how things probably have never been better for investors, and that's both on the retail side and the institutional side. But you can look up, and there's many sources to try and find what the S&P forward earnings estimates are. In fact, I just Googled it now, and I found any number of sources that have not only annual, but they actually have the quarterly estimates as well. And so, for example, I found, looks like this is from Yardini. It showed up just in a search. So their 2021, their estimates are $46 a share for Q2. And then it looks like the consensus among the street is about 46, 44. So what are you looking for there? Well, you don't know what these quarters estimate or earnings are actually going to be, but you want to see, okay, do they outperform? Do they get to a higher number than that or a lower number than that? Remember, they're just estimates until they're actual. And so that certainly is something to watch. And then if you want to drill down a little bit more, You can take a look at margins, net profit margins. You can look at revenues, and you can look at buyback. Some of the buyback stuff is going to be a little tougher for you to look at. But as you hear these earnings announcements come out, remember they always highlight the top and the bottom line. Top line is revenue. Bottom line is net income per share, or net income. And then typically you can take a look into the announcement and see a little bit more. And the other thing I would say to keep an eye out for is you can always be looking at, okay, what's the price of the S&P, the index I'm talking about. So as I said, Friday was 44.11. And then you can take a look at those estimates and you could do the math. Take the value of the index divided by the whatever year the income per share or earnings per share for the S&P. And you can figure out what the forward PE is. And if that's important to you or not, it's up to you. But that's one of the things that people will be talking about. And so before we, a couple more things. So people trying to figure out whether the market's too high, the market's too low. And I can't stress enough, this is the value of having real hedges in a portfolio, because it takes away some of the guesswork in trying to decide, okay, is the market too high? Should I wait? Is the market too low? Should I buy now? The other thing I would say is there are people who try and, put together, I shouldn't say try, really smart people put together different sorts of charts, and they look at PE ratios that we talked about, and they look at subsequent equity returns. So I've seen some where they have the forward PE. Remember, we talked about taking the 44.11, the price right now, or whatever it is when you're listening to this, and dividing it by, you could do the last 4 quarters actual earnings per share, and that would be the PE ratio on the S&P, or you could do the next 4 quarters and the next year, whatever it is, and figure out what the forward PE is on it. And so I've seen data, and they'll plot the data, and they'll go back, a number of years, and they'll say, okay, when the forward PE is here, and think about, an XY graph with a scatter plot, a regression, and they'll say, okay, we're right here. And the line would say, all right, well, at this, typically the average, 1-year return at this valuation is this. The thing is, there's something called an R squared. And R squared is just a fancy way of saying, hey, what's the probability? And I'm using the back of the envelope definition here, but what's the probability that this is, really, really solid? And the R squared on that's only about 6%. It's better if you use a forward PE and you look at the subsequent 5-year annualized returns on the S&P 500 index, including dividends. And you say, okay, if we are at, a 22 forward PE, what typically are the subsequent 5-year annualized returns? That R squared is about 42%. So much better than the 6%. But the point of me bringing this up is that if you could see what I'm looking at, you could see the scatter plot, especially the 1 year. The 1 year is quite a dispersion. And I think it's important to really focus on, having just, I hate to see a lot of people try and make guesses about where the market's going to go or listen to a lot of the noise out there, because it's very easy to make predictions. But if you go back, imagine if you would have listened to expert A or expert B and sold everything and went to cash or bought in at some other time and, leveraged and went on margin and stuff. What happens when they're not right? And so the point is, I think it's much more efficient, much better to just build a portfolio that's really designed for you. And then, as Jay Pestruccelli's book hints at, CEO of Zega, buy and hedge instead of buy and hold. Just be hedged. All right, so we'll leave it there. Please rate, rather than rating and reviewing and starring and doing all that garbage, go ahead and pass this episode or other episodes to somebody else. and maybe someone who's never listened to a podcast before. And I'd also encourage you to go back. This will be 126 episodes that we have now. And I'm always amazed, episodes I did a couple of years ago will all of a sudden out of the blue get a bunch of people listening. I think one of the most popular ones I ever did was I did a companion episode to The Big Short, where looking at the movie, but then explaining what a credit default swap is. I think last time I checked, I don't check it that often, but that probably was among the top few episodes as far as total listeners. And obviously, cumulative listeners. Obviously, that came out several years ago, so we've had several years every week. People were listening to it, but I urge you to go back through the catalog now. And one of the goals is to do a lot of evergreen content, meaning stuff that if you listen to it now, it still hopefully resonates, and try and teach you a couple things. All right, folks, we'll talk to you next week.